Hi, everybody, and welcome back to the Oil and Gas Rundown here at King Operating. I'm Rachel Griffith, Senior Vice President and host of our show today. And of course, joining us, we will be having our founder and CEO, Jay Young, joining us today, along with Eric Rice, our EVP of Strategic Partnerships. Welcome to the show today, gentlemen.
Hey,
How
thanks for
are
having
you?
us. Thanks for having us.
Doing great. So today we're going to jump in. We're going to take a look at what is happening around the world, what's happening at home, and specifically what is happening at the pump. Gas prices are back to about $4.50 nationally. Let's jump in. Let's talk about what is the biggest factor driving higher prices right now.
Well, the biggest factor, obviously, is the war. We've been talking about there's a tremendous amount of supply distractions, problems, disruptions. You know, in the United States quit drilling for oil several years ago, probably 2-3 years ago. They quit drilling for oil because oil prices were down. A lot of consolidations with big companies. So yeah, there's rig counts down. There's four reasons why. Number one, rig counts down. Number one. Number two, wells decline rapidly. Shale wells, as we know, unconventional Wolfcamp, where the oil really is, and unconventional, those wells decline very rapidly, 40-50% the first year. The third reason why oil prices, are going to go up really soon is because supply is going down, but demand is still going. We don't know when peak demand for oil is going to be here. We have no idea. So right now we have oil prices that are going to stay up, even though we had a war, which is number four. I mean, we've been talking, Rachel, on this program for a long time about oil prices are going to go up, stay up, the summertime, into this year, and that was before we even knew there was going to be a war. So we know that now, and unfortunately, Americans are paying They went last Friday. They paid $125 million more at the pump than they did the previous Friday. Just 1 week, $125 million, especially if you live in California or Ohio. I mean, I'm sorry, Ohio's like it's doubled. The price is doubled in Ohio. California, it hasn't really increased that much. It's still high, but it's not gone crazy like it is in Ohio. Ohio has a lot of refinery problems, so the price of oil has jumped up a lot there. But we're seeing now the war's coming to, I don't say an end. I don't know if this will ever be at an end, and we'll talk more to Eric about that because I know he's I don't say opinionated, but he does have his opinions about what's going on there, which we'll jump over to him, in a second. But right now it's just there's so much uncertainty with what's going on. But I don't believe we're gonna see a huge hit in oil prices, even though it looks like there may be some. I don't know if I say stability. I know that Eric's gonna rock all over me on that one. So Eric, just what is your Rachel? Back to
What do you
you. How
think,
about that?
Eric? What do you think, Eric? I mean, are we looking at a short-term price spike? We're looking at a much bigger supply problem. Just break down what you're seeing, what you think. Where are we at? Where are we going?
Yeah, it's a difficult situation to assess and have any sort of strong standpoint on, because we just heard this morning the war was over for the 18th time in 67 days. So we have no idea what's actually the case over in the Middle East. I've interviewed a bunch of people from Iran, and from what I can determine, there's just every war is filled with propaganda on both sides. So somewhere in the middle is the truth. But from an oil perspective, the demand, the destruction that's taking place in the Middle East right now will have long-term ramifications. There have been, from Romania through the UAE down to the Saudi areas, there have been about 13 different refineries that have been blown up. And these things aren't easy to repair, as Jay well knows. I mean, these things cost $30 billion to build. So if they're hit by a missile, you're looking at another 12 billion to fix it. God knows how long that'll take. So the refined product market, which is what gasoline at the pump is bifurcated from crude. So crude feeds that engine, but the refined good at the end of the day, that's where the hits are taking place. There have been some repositories that have been blown up with missiles. So there's certainly crude destruction. So if you kind of look at this in reverse, if you look at COVID, what we saw during COVID was demand destruction. People weren't working, they weren't driving anywhere. You destroyed the demand, so the price went down significantly, went negative for a little bit. What we're looking at now in wartime with operational economies happening around the world is we're looking at supply destruction. It's much easier to recover from demand destruction because you just get back in your car and start driving. Supply destruction, on the other hand, takes a lot of time. And we had a few ships get through the Strait of Hormuz that you can see on satellite view, but that's a few ships. I mean, you're looking at dozens, if not at certain days at high peak, 100 ships a day going through there. So the long-term ramifications from this, I think, people are very much significantly underplaying. I think that the overall agenda that the White House wants to put out is, hey, we created this problem, but it's over in a heartbeat. Well, it's not over in a heartbeat. You still have to refine these goods. You have to be able to take crude and convert it into usable gasoline at 3 different levels. You've got to be able to ship it around the world. And I think the part that people aren't equating to this right now is shipping cost. I was on a Twitter space yesterday, and a guy brought up the fact that shipping cost of crude oil around the world is up 968% in the last 3 months.
Wow.
So not only does it cost money to get it out of the ground and refine it, shipping costs are up 986%. Now that'll drop first. It's a risk to bring these goods through the strait right now in a war. So of course it'll drop first. But if you're really looking at this from is this a short-term or long-term play? The volatility in the market, traders love this volatility. This is where traders make their fortunes for the year. And we're seeing a lot of insider activity and rare trades. Like this morning, something like $250 million was placed 20 minutes before an Axios article came out saying that the war was kind of over. And then 30 minutes after that, the Iranians built a website basically saying this war isn't over. So in a propaganda war, you're going to see fluctuations in the market, but crisis pricing has definitely caked into the market. It's baked into our pricing that we see at the pump. I filled up in Rockwall, Texas 2 days ago for $4.09. When I moved to Texas in 2020, gas was $1.77. So and 4.5 years of that time, or 5.5 years of that time, there was no war. That's just inflationary pricing. So I see that we see relief at the pump coming soon, but I don't see $2 gasoline for a very long extended period of time because we simply don't have the supply to make that number drop. And Jay is right. Mathematically, it's impossible to justify the EIA's numbers of 13 million barrels per day. When you look at the actual rig count, we're probably somewhere between 10 and 10.5 million. But this morning, I don't know if you saw this, Jay, but this morning we exported 8.2 million barrels of oil today. 8.2 million barrels. That's almost an entire day's supply of American oil being shipped over to another country. I think we're looking at a much longer term issue than something that politics solves overnight.
Yeah, it's a lot of their storage. They're doing a lot of storage by exporting a lot of that oil, just trying to make people happy or something. I agree with you, though. I mean, I agree with everything you're saying right now. Wells are shut in the Persian Gulf. 1.2 billion barrels has been cut off or not produced since the beginning of this war. 1.2 billion around the world. So there's going to be a shortage. There has to be. I mean, I know 1.2 billion. I don't even know how many that is. If I started counting right now, 1, 2, 3, how long would it take me to get to 1.2 billion? I mean, a lot. You know what I'm saying? But I also love this. I think that, and I know that Eric's on board with this, and I want to talk about this because we talked about it a couple of days ago. In the backwardation of oil prices. We looked at economics today on some of our oil and gas prospects, and we talked about the backwardation because you have oil prices right now at $100 a barrel. It's going to go to 70, 75 over the next 2 or 3 years for oil. But then you look at our gas production that we're going to have as a company, and you're at 270, I think 275, something like that now. And in 2 years, the same amount of time, it's going to go from 275 to 475. Because of AI and because of LNG, and you're not going to be able to run all these AI plants on electricity, as we've talked about. But what are your thoughts about? And I love the upside of natural gas. There's more upside in oil and gas than there is in oil. I mean, I'm sorry. There's more upside in natural gas than there is in oil. I've been saying this since natural gas was at $2 not long ago. I love the upside of natural gas. It's a lot cleaner to produce. It's a cleaner burning fuel, but I just love the upside of natural gas. What are your thoughts, Eric, on the price of oil and the price of natural gas?
Well, I can't agree more. So if you look at the numbers that are out, and they came out 2 days ago, America is now in a permitting stage, build stage, or final completion stage for almost 5,000 data centers. The next closest country, I believe, is Germany, who's building 500. So we're building 10 times the amount of data centers. Now, what the use of these data centers is in reality, they're now being called military operations. So that's one change in the data center space. But the reality is we don't have enough bandwidth on our grid, our electrical grid in America, which our average grid averages about 70 years old or older. We don't have the power in the grid itself to be able to facilitate even a tenth of these data centers.
Mm-hmm.
So eventually they're going to have to go vertical integration with natural gas. So there are projects right now that are completely private and totally vertically integrated, where they're buying gas fields, hiring drillers to drill for the gas, and then creating 2, sometimes 300-mile pipelines directly to a data center that run into generators. So this is the model that we have right now in America. And again, I can't overstate this number. There are 5,000 data centers in America, either in the permit stage, just getting permitted, or being completed. All walks from one end to the other. The next closest country is 500 total.
Wow.
So we are 10x the amount of data centers that don't have electricity on a grid that will facilitate them being able to operate. They're going to have to go to nuclear and natural gas. And there really are no nuclear facilities that'll power these engines anytime soon. So natural gas becomes this really important bridge in between the, call it the analog world that we live in now into the world of AI, which is going to happen whether you like it or not. I'm not particularly a big fan of overusage of AI. But at the same time, the energy consumption that they'll be using right now is about 4x what we produce right now. So I couldn't agree more. I think natural gas and megawatts are the new gold, and that's the gold rush people are going to be looking for.
Well, I noticed too that they're taking into account that we are going to use natural gas for AI data centers in the future, and that's the reason why the price is going up in the future. Of course, we're not using it today, so the price is less today, but the price of natural gas increases over the next 2 years, and the reason why is because we're going to use more natural gas for data centers. I didn't know that. 5,000. I mean, I know they're 5, building 000. One on the I-20 south of Fort Worth. They're building one right there on the I-20. I mean, they're building them, and I know
the guy's doing it.
Yeah, and
2-gigawatt facility.
Yeah, they're also in the oil and gas and the sand business. I can't remember. I've heard the guy speak a couple of times. I think he's been on my podcast. But anyway, yeah. But these guys are just building these plants, and it's like they run 24/7. They don't stop. They run 24/7. They need a lot of power, and natural gas is going to be needed very, very, very much. And I know that we also, if we can ship it overseas to other countries, LNG. Where we freeze it, naturalize it, and freeze it, take it over, liquefy it, take it overseas. We can also make some money on that as well. So I think it's a great. I've always said we got a great 3 to 5 year run here with oil and gas, and I love natural gas prices and love where they're going to go. And we can't get enough of drilling, and we're producing a lot of natural gas, several million cubic feet of gas a day right now, and we're going to drill a lot more. We're getting ready to frack 3 wells, and those 3 wells they're loaded with oil and gas, so we want to continue doing that.
Absolutely. We've got some good wells coming online that we're excited about. So Eric, I just want to talk again at a macro level. I mean, if we're looking at how prices are, crude prices are affecting the pump there, we're obviously seeing that natural gas kind of staying relatively modest right now, but what are we looking at as far as the economy? What are we looking at as far as inflation? What can, consumers expect to see in the next 6 months to a year if we don't see a resolution in the Strait, say maybe in May, and this continues into the summer?
Well, inflation is a whole separate issue. So the word inflation comes from the ability of a central bank to inflate the dollar supply. So you have to look at that as a side effort. So true inflation is a debasement of the value of a dollar. So things actually don't go up in price. The buying power of a dollar goes down. So in that type of environment, we're already seeing that. We're going from a global hegemony into a hemispheric control or a multipolar world. That's going to cause inflationary concerns to begin with. We have a new Fed chair coming in, Kevin Warsh. He has been very dovish on his statements, though so far doesn't mean anything. But a lot of people think he'll come in and lower rates, 150 or 200 basis points, which will increase inflation. But how do high prices at the pump actually equate into our pain that we experience as consumers? It equates into everything, especially into the Amazon world where something like 40% of all home goods are purchased on Amazon. Well, how do you think they get there? They get put on a rail train that requires oil or coal. They get put on an airplane that requires jet fuel. They get put on delivery trucks where about 10% of Amazon's fleet are electric. The other 90% run on diesel. So everything that you have, and I think Americans really forget kind of the basics behind where things come from. So if you look at the high price of oil, it is a leading indicator in rising prices because if it costs more for Target to ship in, new T-shirts for you to purchase there, they're going to pass that inflationary cost of high fuel onto the consumer. So you'll see a dime or a penny or a quarter added to the cost of every new shirt simply due to high fuel costs. And to be honest with you, Rachel, even if we had resolution and this 14-point plan signed by Iran tomorrow morning, I don't know that actually impacts anything immediately except for market perception. Because what's happening in Iran is a bifurcation of power. You have the traditional government that ran and a decentralized IRGC. These are two separate entities vying for power there, and we don't know who will have it in the end. And of course, we're trying to support one over the other. But at the end of the day, when you see higher prices in gasoline, every American should understand that everything that you purchase arrives at a shelf because of oil and gas, and you bring it home in a car that primarily runs on oil and gas. So the inflationary concerns, I think at this juncture with a new Fed chair coming in a couple of weeks, I think inflationary concerns are doubled. Now, of course, you'll see economists out there telling you there's, nothing's wrong. It's just a blip on the radar. I hope they're right. I've been very right for about 4 years now, or 5 years now, predicting this stuff. And I see our pain at the pump lasting at least a few more months. But what happens over time, Rachel, is you'll notice there was a reason I mentioned when I moved to Texas in December of 2020, gas was $1.77. It's now $4.09. So what happens, the way that this works for inflationary purposes is you'll feel pain at $4.50, $5 a gallon. And when it drops down to $3.25, you celebrate. But it's still higher than it was a few years ago. This trend probably won't end anytime soon. And I see this trend of slow scale upward mobility of pricing in oil and gas lasting pretty much the rest of my lifetime until there's some creative way to do it. So that's just the way I see things. I think that we're probably in a good cycle right now of pain. 450 nationally, Jay, I have a lot of guys on social media that send me stuff and I'll put out pictures of the pump. Hey, here's what I paid in Rockwall, Texas. And a lot of people will share theirs. In Los Angeles yesterday, or Monday, excuse me, Monday, I got a picture in Los Angeles of premium fuel being at 801. Wow. So when you have major metropolitan areas where just driving to work costs you between $7.25 and $8 to drive to work, you're going to feel a lot of pain, and that's going to trickle down because those trucks that drive your deliveries or make stops at your grocery store, they fill up at those same pumps. There's no magical pump where the delivery guy gets cheaper gas. Yeah. So yeah, Rachel, I think this has big, overwhelming economic concerns through the summer.
Yeah, Jay, what does this really mean? I mean, looking at everything that's happened since March, looking at the Middle East, the fact that now we're starting to export some oil we really don't have enough oil, production for ourselves in the U.S. What kind of focus, what does this story now look like going into 2027 for actual investment in the U.S. production? What do you see on the horizon that could change? And Eric and I were having a brief conversation about this also, so we'll pull you in a minute, Eric. But what do you see changing? Do you foresee anything changing in 2027 and beyond?
Definitely. We're going to drill some more wells. Rig count's going to start ticking up here in the next 3 months, 6 months or so because, hey, when you have more oil and gas prices are higher, a lot more prospects make sense, and you drill your best wells or best locations first, and then you take to your tier 2 acreage, and then you drill those second. But you're going to see a lot of people start to increase and look to increase production. So they're going to get rig count. They're going to start drilling, and all of a sudden you're going to see supply start moving up. I don't think demand's going anywhere. The good news with this, and just a few short years ago, we were producing like 1 million barrels, like 2008, 9, 10. right when I sold a bunch of Permian assets. I couldn't have sold them at a best time for the buyer or worst time for me. I sold a lot of Permian assets right at the end of 2008 and 9, and then horizontal drilling in the Permian came out and it went crazy. So the Permian Basin's gone from 1 million barrels to 6.5 million barrels in a short time, which has allowed the U.S. production of oil to go way up. Eagle Ford, the Bakken, 1 million barrels, 1.5 million barrels each. I mean, that's the reason why we're producing 13 million. Thank goodness. If we weren't, I mean, price of oil would be $200, $300. That's what a lot of the people sitting on the sideline don't understand, is that because we have been drilling and successful drilling horizontally in the Wolfcamp and Permian Basin, we're producing 6.5 million barrels. If not, we'd be producing like Eric said, 10.5, but let's just say 12. If we're producing 12 right now, we'd be producing 6. We would be under the gun for so many different countries right now if we didn't produce all this oil. But thank goodness we are producing all this oil. We're going to have to do something to refineries. We're going to have to go back in, and we got to quit shutting these refineries down in California. They've got 2 or 3 of them that they're shutting down. And what Eric says is 100% right. We need 10 to 15 different refineries right now. If we had our own refineries, and we could, if we could send every barrel of oil that we produce to a refinery in the United States, game over. I mean, yeah, price would go way down and we wouldn't have to worry about this. But that's not going to happen anytime soon. It costs so much money. It costs a lot of money to build a refinery, to rebuild them, or to build them back up. And, with a lot of people out there with Democrats, and you'd have lawyers back and forth and lawmakers, and you couldn't do it in Colorado. You couldn't do it in California. I mean, there's moratoriums all over the world with fracking. So it's a hard battle. It's a hard battle. But if we continue this hard battle, we're going to have a lot of problems with the price of oil and gas, which, in my opinion, is going to stay up above $80 a barrel. Gasoline prices are going to $3, if not $4, really soon. And we're going to be producing oil and gas here. And our funds will do a lot better, obviously, at the higher prices, and we're going to continue to drill. We had our big King operating meeting this morning, and we talked about prospects. We've got hundreds of locations to drill right now, and we are getting rigs to start drilling like crazy for our investors, and we're really excited about that.
Absolutely. Eric, just bringing you in on the same conversation and kind of your outlook on what we're going to see domestically that might change going forward.
Well, I think it's pretty obvious that we're going into hemispheric control. Like, the world is being broken apart. Globalism is kind of at an end. That's what we're watching, whether you're paying attention to it or not, which means that energy independence, I said this 2 years ago during the campaign, if we were to truly become energy independent in this country, you need about 13 more refineries. They cost anywhere between $20 and $35 billion a piece to build. Add that together, you have $390 billion that's needed immediately in government funding to build these facilities. It's not going to come from the private market. You're going to have to reduce regulations significantly to increase profit margin while the price plummets, because you'll increase supply. So you will have cheaper prices at the pump. You'll have cheaper prices for oil, but it'll be much less expensive to drill them, maintaining the profitability of the oil and gas sector in America, which is a huge contributor. So I think that over the next 3 to 4 years, I think we are going to see some of these refineries get turned back on against the will of politicians and lawmakers, because it's what's best for us. Because if we don't do that and we continue, like right now there are 11 countries, maybe 13 countries, 11 to 13 countries right now that are offering up and are emptying their strategic petroleum reserves to offset the oil price that's being caused by the jam up in the Strait of Hormuz. Strait of Hormuz isn't the only target. You have the Strait of Malacca. You have a lot of other military targets out there that restrict shipping. So we could see more of this stuff in the future. And to be honest with you, on the oil and gas side, that's kind of the minimal pain. I think the real pain that we're going to see is the reduction of crop production coming up from the lack of fertilizer. Mm-hmm. But I think that we are certainly going to see a time frame, whether it's this year or next year, where the conversations about becoming vertically integrated in our oil and gas production become paramount for the success of this country. And if those conversations aren't happening, we don't have serious people in Washington, D.C. concerned about the American people. We would be a very flourishing company if we could do what Jay exactly said. We drill oil in the Permian. We send it to our own refinery. We have our own gasoline. We save on shipping. We save on overseas fees. We save on risk of shipping it across the globe. That is a big turning point that, again, I agree with Jay. I don't think we see that anytime soon, but I think 2027, the conversations begin. They better begin. Otherwise, voters better get on their high horse and start riding into DC, because it's going to be a disaster if that doesn't happen.
Yeah.
Yeah, very interesting. As we're winding down, a question for each of you. I'm gonna start with Jay. So, I mean, this has been a very interesting year, 2026, just in the oil and gas world in general. We've got what happened with Venezuela, and we don't even hear about Venezuela very much. Now we've got what's happening in the Middle East. We've got United Arab Emirates pulling out of OPEC. We've just got a lot of very interesting things happening. Jay, what is something that you foresee as the next shakeup, the next possible, wow, look what happened? That is a little tricky question. I'm getting here. What do you see that could be a shocker to us?
Well, I'll tell you what, I was surprised at Trump in Venezuela, but I'm not now, because we talk about how much oil is there. There's 300 billion barrels supposedly. Who knows? But the thing that really worries me in the oil and gas game is, what's going to happen in the United States. We're producing, like I said, 12, 13 million barrels a day right now. That's about 5 billion barrels a day. We have about 30, 40, 50 billion left. Some people say 30 billion, some people say 50. That's about 8 to 10 years worth of supply left. And we're done, which is not true. I will say that. It's not 100% true. But people say we have 30 billion, we're producing 5, that's 6 years. But we'll recreate it. So like the Permian Basin, it will recreate it. It'll find a new way to shake itself up. It will produce more oil in the future. But I feel like that there is not a lot of places that you can continue to drill here, because we have so many oil and gas companies that drill here, produce oil here, and are obviously they're profit oriented, and we like to drill in oil and gas, and as long as it's here and as long as we have the inventory, we're going to drill. Venezuela, I think, is very smart. There's been a lot of companies, Hunt Oil, Crossover Energy, HMK. There's a lot, ConocoPhillips. These companies going back down to Venezuela, they're going to make a shakeup down there. And as long as they can get paid for their oil, and they know that they're going to get paid, I can't remember which company it was, Chevron or ConocoPhillips, that they still owe them like $20 billion. I think Chevron's $1 billion or something. But because they produce all this oil, and the country takes over the check and takes over the production and takes over the check and says, oh yeah, hey, we're not going to pay you. Well, I think that's changing now with Trump going in. Now, when Trump's out of office, I don't know. If you get somebody, Harris, Kamala Harris or something, if she's in there, is she going to go back into Venezuela and say, hey, you got to pay these people? Use leverage, use everything. I don't know. But I'm just saying right now, with Trump going in and having, if I spend $5 billion in Venezuela as a company, and I produce oil and gas, and when I sell the oil and gas, can I get my check? And that's what Trump's promised all the oil and gas companies right now. They're going back in and saying, okay, let's relook it. Let's go back in and look at this thing again, and let's see if we can't go in, because it's got a lot of reserves. Like I said, 300 billion, 10 times what the United States has. It has an incredible amount of crude left. There's a lot of shale drilling, which is horizontal, and I believe Venezuela is going to make a difference.
All right. Jay saying Venezuela is coming in for some sort of shakeup in this next picture. Eric, what do you got? I mean, no one's even really talking all that much about Russia, Ukraine. I mean, their war is somewhere on the side. Now we've got China, who was stockpiling oil for a long time. I mean, what do you see as something interesting that's popping up on the horizon in the next year?
Yeah, it's hard to keep up with all the psychological operations that are happening. It's difficult. The one thing I think people aren't looking at for the shakeup in oil and gas, you brought up the UAE, and the UAE is essentially dismantling OPEC, which has been a pricing cartel since its inception. That's essentially what we've seen. I think one of the biggest shakeups we're going to see is, we see these efforts, the dollar, all of this stuff rotates around the dollar. So we can talk about oil and gas all we like, it's priced in the dollar. So the dollar is what you really watch for the shakeup. And I think one of the things that we're seeing right now out of China is their lack of concern about sanctions. Xi came out yesterday and basically said, we don't care what sanctions you're giving us. We're still buying oil from Russia. We're still going to buy it from Iran. The ability for a global hegemony to sanction people against their will, I think is something that's causing the breakup of globalism. And I think if we watch the dollar, and it's the only reason that our government passed a stablecoin bill was to buy the debt. So if you have a stable coin, it has to buy a T-bill. So that's constant debt demand. So if we're looking at the dollar, we're looking at sanction relief, where in general, the past it's been, we're going to remove the sanctions for you. With new currencies popping up, sanctions don't matter anymore. So right now, a lot of that oil in the Strait of Hormuz is being purchased with Chinese yuan. So the crypto blockchain methodology of one currency rotating throughout one blockchain actually makes a lot of sense for this. And I think that's where the shakeup occurs. And I think going from a global standard into regional powers, which is going to happen all throughout the world, I think that's going to be a 2 or 3 year shakeup in the market. We don't know what will happen with that. I don't even have a way to anticipate it, but I think that's going to be a leading indicator of the next shakeup in the market itself. Will be what happens with the dollar over time.
Yeah, absolutely. Well, I feel like every time we get on these lives every Wednesday, things are just a little bit more weird, a little bit more interesting to observe. And so it's going to be great to get back on here next Wednesday. You guys were always here on the rundown every Wednesday, King Operating. So make sure you're tuning in, and make sure if you have questions, you want to find more about our opportunities in oil and gas, then make sure you go to kingoperating.com, fill out that learn more form, and definitely connect with us. We can share with you how you can actually take part in what is kind of the next upcycle in oil and gas right now. So next, let's see, we've got our webinar coming up. That's going to be the 14th, and we want to invite you to that. We are going to have Dan Steffens, incredibly knowledgeable about the oil and gas world, what's happening, what his outlook is, what he's forecasting for investors as well. This is very timely. John Mauldin, our chief economist here, going to kind of break down how this is affecting the market. So we would love for you to join us. You can definitely go to kingoperating.com and fill out a learn more request, or go to the upside at King Operating. We can send you the registration link. So everybody, thank you for joining us at the Oil and Gas Rundown here at King Operating. Gentlemen, thank you so much for being with me today.
Absolutely. Thank you.
Thank you. Thanks.
All right. We'll see y'all next week.
100%.